the hour between dog and wolf, risk-taking, gut feelings, and the biology of boom and bust. This summary is based on John Coates's work. The Hour Between Dog and Wolf, with a unique background in neuroscience and finance, takes readers into the intertwined worlds of physiology and high-stakes financial decision-making. His insightful book investigates the ways our bodies and brains react to risk, showing that market behaviors are influenced not just by logic or economic factors, but by powerful biological forces as well. Part 1. Mind and Body in Financial Markets. In the opening section, Coates introduces the reader to the deep connection between mind, body, and risk-taking in the world of finance. He explains that when traders are exposed to risk, their bodies respond with the same physiological mechanisms as if they were facing physical threats. This reaction is grounded in the fight-or-flight response, a survival mechanism that has evolved over millennia. For traders, this response manifests as a rapid heartbeat, increased adrenaline, heightened alertness, and a boost in physical readiness as their bodies brace for potential outcomes. Coates illustrates that risk-taking in financial markets triggers the body in much the same way as intense physical activities do. For instance, just as a soldier prepares for a dangerous mission or a mountain climber tackles a steep ascent, a trader's body goes on high alert when making big investment decisions. However, unlike physical risks that last for brief moments, financial risk can be prolonged over weeks or even months, especially during volatile market periods. The human body, designed for short bursts of intense stress, is not naturally equipped to handle the chronic stress of ongoing financial uncertainty. This prolonged state can lead to negative health effects, such as high blood pressure, depression, or even immune system breakdowns. In examining these reactions, Coates points out that traders often oscillate between euphoric highs when they're on winning streaks and intense stress or anxiety when they're losing. For example, the body releases testosterone during repeated successes, which increases confidence and appetite for risk, potentially leading to overconfidence and irrational decision-making. On the other hand, the stress hormone cortisol spikes when traders experience losses, increasing anxiety and caution, which can lead to a more risk-averse behavior. Coates argues that the roller coaster of emotions that traders experience is not merely psychological, but deeply rooted in biology, shaping the way they interact with the market. Part 2. Gut Thinking. The second part of the book delves into the fascinating world of gut feelings, highlighting how our bodies play a role in quick, instinctual decision-making. Coates explores how gut feelings are more than just intuition. They are rapid, unconscious judgments that the body has honed through evolution. These gut feelings are processed in the brain, but the reaction is so fast that it can feel automatic, allowing individuals to make split-second decisions without overthinking. This kind of thinking is invaluable in settings where time is critical, such as financial trading or sports, where an immediate reaction can determine success or failure. Coates explains that the body's early warning system relies on specific brain regions, such as the amygdala and the locus ceruleus, which react to changes in the environment before conscious awareness even kicks in. For instance, a subtle shift in stock prices may signal to a trader that something is about to happen, causing them to act instinctively, even if they cannot articulate the reasoning behind their choice. These gut feelings are based on previous experiences, observations, and complex neural processes that quickly identify patterns or anomalies. The trader may not know precisely why they are reacting, but their body does, driven by millions of years of survival-based evolution. Coates also points out that gut feelings can sometimes be more accurate than conscious, logical thought, especially in complex, unpredictable environments. This is because gut feelings integrate emotional, sensory, and cognitive information, offering a holistic approach to decision-making. For traders, gut instincts are an essential part of their toolkit, providing a form of nonverbal intelligence that supplements data analysis and financial forecasting. Coates describes this interplay between instinct and analysis as a crucial advantage for those in high-stakes fields, where fast responses often yield better results than prolonged deliberation. Part 3. Seasons of the Market. In this section, Coates explores how financial markets resemble natural cycles, moving through periods of expansion and contraction much like the seasons. He describes how these seasons in the market, booms and busts, are driven, in part, by the biological responses of traders and investors. During bull markets, when optimism and stock prices are high, traders experience a surge of testosterone. This hormone, which enhances confidence and risk tolerance, can make traders feel invincible, leading to ever-increasing risk-taking. Coates likens this phase to the biological behavior seen in mating or competition, where animals are emboldened by high testosterone to fight for resources or status. As the market continues to rise, this hormonal high pushes traders to take bolder and riskier positions, often disregarding caution in favor of capturing more profits. Coates provides historical examples of bubbles and manias, where irrational exuberance led to massive investments in risky assets. He notes that this phenomenon is not just a psychological one, but a physiological state, as rising testosterone levels create a feedback loop of increased confidence, reinforcing risky behavior. This cycle reaches a tipping point when the market, unable to sustain such inflated prices, eventually crashes, resulting in a bear market. During these downturns, cortisol levels rise sharply. Known as the stress hormone, cortisol prepares the body for fight or flight by sharpening the senses and redirecting energy to vital functions. However, when stress persists, as it does during prolonged market declines, high cortisol levels can lead to chronic anxiety, risk aversion, and even depression. Traders in this state may become overly cautious, fixated on avoiding losses rather than pursuing gains, which only intensifies the downward cycle. Coates compares this phenomenon to the ancient Greek concept of hubris followed by nemesis, excessive pride leading to downfall. In financial markets, this biological cycle of boom and bust plays out as an inevitable pattern influenced by the hormonal responses of those making high-stakes decisions. Part 4. Resilience. The final section of the book turns toward resilience, focusing on how individuals can build psychological and physical toughness to withstand the highs and lows of risky environments. Coates discusses how techniques from military and sports psychology can help traders and others in high-stress jobs manage their responses to risk and uncertainty. By developing resilience, individuals can reduce the negative impacts of prolonged stress, minimizing the likelihood of burnout or poor decision-making. Coates explores resilience training programs that emphasize physical and mental conditioning to help individuals manage stress better. These programs, which are used in elite sports and military training, include practices like controlled breathing, mindfulness, and mental conditioning. Coates explains that such techniques help calm the body's fight-or-flight response, allowing for clearer thinking under pressure. For example, controlled breathing helps regulate the heart rate, preventing panic in high-stakes situations, while mental conditioning techniques build mental endurance, allowing individuals to face challenges without feeling overwhelmed. Coates proposes that resilience training could be particularly beneficial for financial professionals whose careers are shaped by the market's ups and downs. In such roles, resilience could help them maintain composure during periods of intense stress and avoid the pitfalls of both excessive risk-taking and paralyzing fear. By preparing the mind and body to handle stress, these techniques could contribute to a more stable financial system, as traders would be better equipped to manage their biological responses and make sound decisions. He also touches on the idea that understanding and controlling these biological responses could prevent financial professionals from succumbing to the cycles of euphoria and despair that destabilize markets. With resilience training, Coates envisions a new approach to risk-taking, one where traders harness their physiological reactions productively rather than being overwhelmed by them. This section offers hope that by addressing the biological roots of risk-taking, individuals and institutions could foster a more balanced and sustainable approach to financial decision-making. Key takeaways from the book. 1. The body's role in financial decision-making. Coates emphasizes that decision-making in financial markets is not purely cognitive. It is intertwined with physiological responses that prepare the body for action. Recognizing this connection provides a more holistic understanding of behavior in high-stress environments. 2. Hormonal impact on confidence and caution. The book reveals how hormones, particularly testosterone and cortisol, influence our responses to risk. Testosterone fosters confidence and risk tolerance, leading to greater risk-taking, while cortisol induces caution and fear, often leading to risk aversion. Together, these hormonal cycles can mirror market cycles, creating a biological basis for market volatility. 3. Gut feelings as an evolutionary advantage. Gut instincts are rooted in our evolutionary history, designed to help us make rapid decisions in unpredictable environments. In finance, these instincts provide a form of embodied intelligence, allowing traders to respond quickly and effectively in high-stakes situations. 4. Biological basis of market cycles. Coates argues that market cycles reflect the biological cycles of those who operate within them. The confidence brought on by a bull market aligns with high testosterone levels, while the stress of a bear market correlates with high cortisol. These biological cycles contribute to recurring patterns of boom and bust, impacting both individual traders and the market as a whole. 5. Resilience as a path to stability. Coates proposes resilience training as a way to manage stress and stabilize financial behaviors. By training the body and mind,